Hello, welcome this morning. To this session, we're going to talk about financing concepts. So listen, we're going to look at what seller financing is, and we're going to look at some types of loans. Very important section to recognize a few of the types of loans, especially when it comes to the national portion of the state exam. My name is John Ensing. I'm a certified real estate instructor both in Florida and Louisiana. My specialty is to do one-on-one training or private tutoring with you, the student, to prep you for the state exam, okay? Help you with anything that you need in common law and civil code or the state portion. So you can go to privateturingsession.com, privateturingsession.com if you want to book an appointment with me. Or you can email me at john.ensing@gmail.com. All right, let's get started. Here we go. Let's talk about some financing concepts. Now, in another tutorial I did, I talked about fixed rate loans, non-conventional loans or conventional loans that are fixed rate, non-conventional loans, which are government loans, and I talked a little bit about seller financing. So we're going to kind of go in and indulge a little bit more into seller financing. What is seller financing? Well, it's a private person. Let's say a buyer doesn't have credit or doesn't have good credit, okay? In other words, try to get pre-qualified, but could not get pre-qualified. So there's an alternative method to be able to go and purchase a home. It's called seller financing, okay? So they can outright do financing with the seller and set up the banking terms, you know, the term loans, the loan terms on the property, and just do a straight seller financing. Or they can do what they call an installment contract or a land contract, as we mentioned in another tutorial. That's nothing more than an agreement that the seller is going to put in the agreement the financing terms, and the borrower or the buyer of the property in a land contract is going to have equitable title, which is possession only, with the intent of owning the property in the future when the loan's paid off. That's called legal title, okay? So equitable title is just possession with the intent of owning it legally, called legal title, in the future. Remember, seller financing is not a federal loan. It is not, they're not considered federal lenders, okay? Now, let's talk about types of loans. Now, you want to know a few of these for the state exam. No doubt recognize these when you see them on the test. So the first one, and the most, probably the most recognized that's done in purchasing today when it comes to home loans, is called amortized loans. Amortized means to pay back, okay? You've got equal installments. Let's say it's a 30-year loan and your payments are $1,200 a month. That $1,200 is going to stay the same no matter what interest rates do, no matter what happens to the economy. $1,200 a month is going to stay the same all the way through 30 years. Nothing changes. What happens as the payments go to the lender is going to take that check and take part out for principal, which is the amount that goes towards the loan, and part of it goes to their interest that they're going to collect. The principal part they get is called a direct reduction, okay? So this is what reduces the principal of the home down to, at the end of 30 years, you have a zero balance. Amortize, pay back. That's what it means to pay back. Equal installments, okay? And so it's a price reduction over time till the loan's paid off. Now, interest is also taken out of the installment, or the $1,200 a month in this example. And it's front loaded. So you notice if you ever bought a house before, your first payment you made, and then you get your next month's statement, and it shows you only put like $40, $50 towards principal and $1,150 towards interest. That's because they collect all the interest up front. And as you get into the loan and years down the road is when more of the money goes towards the principal. Again, until you get to the 30-year term is when the house is paid off. So amortize means to pay back. Equal installments. Remember, the principal interest is going to be the same all the way through the term of the loan. It does reduce the principal. It is a price reduction until it gets down to zero balance at the end of the loan. Okay, it's called amortized. Now, the cousin or the other part of amortized is called partial amortized loan. Okay, really the concept's no different, except your actual installment your equal installment, in other words, the payments you're making through the term of the loan, is not going to be a full amortized payment to give you a zero balance. It's going to come up short. So instead of coming up zero balance at the end of 30 years on an amortized loan at $1,200 a month, let's say you're only paying $1,050 a month. Well, you're going to come up with a balance at the end of 30 years. That's called a balloon payment. You want to know that for the state exam. A balloon payment is the final payment of a partial amortized loan that needs to either be refinanced or paid in full. Okay? So amortized, payback, equal installments, zero balance at the end. Partial amortized is partial payment, again, equal installments, but it's partial payments going through towards principal and interest. And at the end, you don't have a zero reduction or a zero balance, but you do have a balance called the balloon payment. Okay, so that's the final payment of a partial amortized loan. Okay, so you want to know these two. The next one we're going to look at is a term loan. A term loan is strictly interest only. You know, if I borrow $50,000 from a bank to purchase an investment property, or $100,000, or however much I'm borrowing to purchase a home, and I'm going to borrow it under the loan program of the financing product called a term loan, and it's at 6%. Let's use this even number. 6% on a $100,000 loan is $6,000 a year. Okay, so $6,000 a year, and if I pay on that for 10 years, and I'm paying $6,000 a year on interest, of course you're going to divide that by 12, and you got monthly payments. But if I'm paying $6,000 a year, then what's my balance at the end of, say, 10 years? It's going to be $100,000, okay? Because it's all going to interest. You're not doing a price or a loan reduction, a principal reduction. Like an amortized loan, it goes to interest and principal. But here on a term loan, it's just going to interest. So your final balance is going to be $100,000. It's not a balloon payment, but it's somewhat of the same theory. Okay, so term loans, interest only. Very, 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 listen to me carefully, very, not a dangerous concept, but you got to have the right environment to do this. The economy's got to be good if you're going to get an investment property and you're going to go in and get a term loan on it, because actually you're going to be paying less monthly, okay, because you don't have a principal payment involved. It's just interest. So it's going to be a smaller payment, but you don't have any price reduction. So term loans are used a lot when people are flipping homes, but you got to have an economy for it, because your holdover costs, you don't want it to extend because you're not getting any price reduction on it. So there's a time and a place for a term loan. Interest only. The next one we're going to look at is an adjustable rate mortgage, or what they call an ARM. Okay, an ARM, adjustable rate mortgage. This is also a fixed rate loan. It's amortized over 30 years. Equal installments, okay? Equal payments. The payments can adjust through the period of the ARM up to 30 years because of the interest rates adjusting, either up or down, okay? That's the whole concept of this financial product. The interest rates will adjust. So if I got a 3-year ARM, my interest rates could adjust up or down every 3 years through a 30-year loan. So I'll see my payments could be going up and down throughout the term of the loan due to the interest rates adjusting. Very, very risky loan, again, to get for a long term, because you don't know what the future holds, okay? If interest rates really go up, then, you know, every 3 years you could be climbing and your payments get higher and higher and higher, put you into a kind of a mess. So watch these adjustable rate mortgages. They do serve a time. Again, a lot of people use these for investment properties to flip, and or if they're going to hold it for a short term, maybe 5 years, and then sell it and put a tenant in there. There's a time and a place. But if you're going to buy a house to live in for 30 years, adjustable rate mortgages are very risky. All right, blanket mortgage. A blanket mortgage is more for land coverage by a developer. If I go out and buy 1,000 acres, okay, let's say for $2 million, and I'm going to clear that land and build a neighborhood, and I've got 200 lots in there getting ready to sell to builders, and I get builders that come up and buy these individual lots in three lots per purchase, they're going to have a release clause from my $2 million loan, because if I end up forfeiting or going or not paying the debt service on that $2 million loan, they've got to have a protection. So what happens is when they purchase the lots from me, I actually give them X amount of dollars to the lender towards that $2 million. They give me a release clause to give to the purchaser, which means they're no longer under that umbrella that's being lent from the bank on that $2 million. They're on their own. Okay, so they got kind of a protection. It's called a release clause for the individual purchaser. So blanket mortgage covers the land, and that's what it means to have a release clause. Is anybody that buys a lot, for example, is not going to be under my $2 million loan, but they got their own loan, and they've got a release clause that protects them and says they own their land on their own. Package mortgage. This is real property and personal property. So for example, you know, condominiums and townhomes and beach houses on the Gulf Coast, investors that buy them could turn around and sell them, and they'll sell them furnished, and they could get financed with personal property in them. Up in the Midwest, you may have farmland that has these big combines, okay, these big farm equipments that are still declared personal property. And so that can be sold again with real property. So it's a package mortgage for the ability to purchase real property and personal property. And then an interim or construction loan is, again, it's an interest-only loan specifically designed for construction purposes. Okay, so if you as a borrower own a lot and you hire a builder to build a floor plan that you give them, you're actually only going to pay interest only. Of course, the bank's got to approve everything, the plans and all that. All that's been approved. Your payment is only paid on what is being built. So for example, let's say it's a wooded lot. You own the lot and you get an approved loan for $300,000. They're not going to give it to you all up front. What's going to happen is the contractor who's in charge that subcontracts all the work out, first thing you got to do is clear the land. Well, there's a cost to clear the land, and that's submitted to the lender. The lender pays the contractor to clear the land. The bank sends an inspector from the parish or the county out to make sure it's done according to code. Once that gets approved, then now you can draw another payment for the next phase. Forming up, pouring concrete, running your plumbing, all that needs to be done next. Well, there's a draw for that. And so you're only paying interest on what you're borrowing. The word is draw, what you're drawing per phase until the house is completely done. And you've got the final inspection called a certificate of occupancy, where you can move in and dwell. Then at that point, and this is all done up front with the lender that's giving you a construction loan, we'll also have what they call a takeout commitment. They'll take that construction price, that total price that you're paying interest only on, and they're going to convert that to long-term financing, an amortized loan over 30 years. Okay, so this is interim, or what they call construction financing or construction loan. Interest only, you're only paying on the draw per section of the building or the home that you're building. Okay, and at the end, a takeout commitment, they'll convert it to long-term financing. And listen, I hope you enjoyed this little short session on financing concepts. We talked about seller's financing. We talked about the different types of loans and loan programs. Got to know this for the state exam. Okay, again, if you need some private tutoring, go to privateturingsession.com, privateturingsession.com. Good luck on your exam. Bye for now.